Hello and welcome to the Corcoran Codex, my YouTube channel. If you are a first-time visitor, then welcome. And if you are a returning visitor, then welcome back. What I want to look at in this video is really quite a critical idea in, say, the debt market or credit markets, really. And it has to do with spreads or credit spreads, the difference really in yield between let's consider a 10-year US Treasury note, which is issued by the US government with the full faith and backing of the USA, and thereby is deemed to be credit risk free, versus, let's say, a bond issued by a corporation, whether it be an investment grade company as determined by the ratings agencies, or a sub-investment grade company. Now, in the latter case, bonds issued by sub-investment grade companies are often referred to as junk bonds. And to make this discussion very topical, as of when this is being recorded at towards the end of September 2025, there is growing concern, which I share, that the credit spreads in the debt market or bond market, let's say, are underestimating the risks of default. And in fact, there are two examples, which I shall come on to shortly, to illustrate that there is growing concern that default risk might have been underestimated and needs to be taken more seriously. Okay, so let me begin this discussion by looking at a very useful credit spread, one which is very widely followed in the financial markets. And this is the yield spread between a 10-year US Treasury note, which of course is issued by the US Treasury, and it comes with the full faith and backing of the USA, and there is deemed to be no credit risk attached to it. And the other item in the spread in this case is essentially an average junk bond or high yield bond, to give it the more respectable name, but they are very often called junk bonds. Now, the diagram on the screen comes from the Federal Reserve, the branch in St. Louis, and this is a database which is easily accessible on the web. It is known as the FRED database. Now, what I've done here is I've gone all the way back to 2016, and this is current as of late September 2025. And let's just walk across the timeline here and see what the diagram shows. So at this point here, the spread is 9%. Now, just to give, say, an illustration to what that really is showing, is let's us suppose that the yield on the 10-year Treasury note at around that time was, say, 2-3%, something like in that order. If it, let's say, for example, that the yield was 12 on the junk bond, we subtract the 3% yield on the 10-year Treasury, and we end up with a spread or difference of 9%. That is quite high, as can be seen by looking at the rest of the diagram. Now, this spread then started to contract significantly and came down here to, for most of this period here, to be in the region of 3-4%. So once again, let's say that the yield of the 10-year hadn't changed a whole lot, maybe 3-4%, and it means that you then, if you're looking at a spread of, say, 3-4%, then the equivalent junk bonds would have been yielding 6 or 7%. That's how you get to the spread. Now, this is here the onset of the COVID pandemic at the beginning of 2020. This is basically Q1, Q2 of 2020. Now, of course, during this period, there was great concern because basically cash flows had sort of fallen off a cliff, something I'll come back to in a moment. And because, say, cash flows had fallen off a cliff, businesses were in lockdown, as more or less the whole population was. The concern, of course, was that there could be increasing defaults, significant defaults perhaps, especially for junk bonds. These are sub-investment grade bonds. These are companies far more vulnerable to adverse economic conditions, and there could then well be a serious collapse in the junk bond market. So the spread moved all the way up now to 11%. And bearing in mind that around this time the yields on 10-year notes, Treasury notes, were somewhere around 1 to 2%, we're really looking at an effective yield of 13–14% to get to the spread up here at 11%. This, of course, set off alarm bells, especially, for example, within the Federal Reserve, and I'll come back to what they actually did to address this concern. Anyway, the spread came way back down as a result of various measures taken by the Federal Reserve, which we'll come on to in a moment, and we came all the way back down to a level around the same as where the spread had been before the onset of COVID. And you can see some move up and down here, but what I want to draw attention to really is over here. This is as of late September 25, and we are now down below 3%. We are actually at a level which is really only just been seen around here at the beginning of 2025, not seen anywhere else across the 10-year timeline on this diagram. Now, what this is effectively saying is that bond investors, people who are buying bonds, in this case junk bonds, are very complacent really about the risks or potential risks, default risks, credit risks in this case the junk bond market. If they are willing to essentially only require not even a 3% credit risk premium to be willing to buy sub-investment grade bonds, that suggests that there is, to put it rather bluntly, there's a lot of complacency amongst those institutions, such as big pension funds, even sovereign wealth funds, asset management funds, and so on, that are buying the sub-investment grade bonds rather than, say, taking on the default risk-free bonds, which are the Treasury bonds. The concern that I've just expressed on that last slide is now being echoed in, for example, as can be seen here, this article from the Financial Times dated September 24, 2025. And you can see that US debt investors are raising alarm over lending standards, especially in the corporate bond market in the United States. Concerns come after collapse of two companies deemed just weeks ago to be in strong health. And we'll come on and discuss this further in a moment. But the two companies involved in this particular article are this company here called Tricolor and First Brands Group. And it says here, the failure of subprime auto lender Tricolor Holdings at the start of this month, so back in early September, followed the exploration of bankruptcy proceedings by car parts supplier First Brands Group, which has wrong-footed investors. So let us dig a little deeper into what the article is pointing to. Let's have a look at the diagram on the screen here. So this shows you the significant drop, or the plummeting value of these First Brands instruments. As I say, they are essentially leveraged loans, which are loans that are packaged up by a principal lender like a bank and then sold off to other investors. This could be into the private markets, in the private credit market, for example. It could even be to other investment funds, asset managers, and so on. And as can be seen, the first lien loan, which would of course would be the preferred position, less credit risk, the drop in the value has brought these loans down to 60 cents on the dollar. And in the case of the subordinated claim, or the second lien loans, this has come down even below 20 cents on the dollar. And as it says, both companies, that includes the Tricolor company, they made use of asset-backed debt. Tricolor bundled up subprime car loans into bonds, and First Brands was tapping specialist funds to provide credit against its invoices. This is a form of invoice factoring, which has had other where there have been other significant casualties in the past. And the AFT goes on to say, at its core, asset-backed finance is the ability to lend against a specific asset or loan, including consumer credit card balances, leases on rail cars, solar panels, aircraft, and even music royalties. This is a very important niche in the credit markets, of course. When I began, I showed the yield spread between the US 10-year Treasury note, which of course is credit risk-free, and the yield that would be paid out, say, on a 10-year junk bond. And I showed you that that moved up and down, and I drew attention to the very wide spread, 11 full percentage points, at the beginning of the COVID pandemic in the first quarter of 2020. At the outset of the COVID pandemic, as we saw, when cash flows fell off a cliff, there was widespread concern in the debt markets about the increased likelihood of corporate bond defaults. In an unprecedented move, the Federal Reserve began to purchase high yield or junk bonds, a decision that highlighted their concerns about a potential meltdown in the sub-investment grade corporate bond market. They made then the decision to buy not only investment grade corporate bonds, which is something that they had done previously, but they went even further in Q1 2020 by going into the junk bond or sub-investment grade market and buying up bonds of that credit quality with a sub-investment grade rating, essentially. And as you can see here from this diagram, essentially from Bloomberg, in the investment grade market, on the left scale, this is the spread between, say, an investment grade corporate bond and a 10-year Treasury, and the yield got up, the spread here for IG bonds got up to close to 400 basis points or 4%. But more dramatically, over on the right scale, this shows you the spread between the junk bonds and the equivalent 10-year Treasuries. And as shown earlier, this spread reached 11%. But the decision by the Fed to warehouse junk bonds temporarily on their balance sheet provided support not only to the high yield market, the sub-investment grade market. You can see the yield spread came way down from around 11% down to a 6% spread, and it also provided support in the investment grade corporate bond market as well. Well, I hope very much that you found that discussion to be of value and useful and interesting. And could I once again remind you to subscribe to my channel, the Corcoran Codex. It will allow you to receive notifications as to when I add new material, which I do on a regular basis. All of the material is around this general topic of analyzing critical ideas and episodes in the world of global finance. Might I also just take this opportunity to mention 2 books that I have written over the years, both published by Wiley, and you can see them there. Thank you very much for watching.